In outcome number 2, we have someone that needed more insurance. We have the same assumption on that policy, that it was $1 million policy. It had 5 years left on the guarantee. The premiums were $8,500 a year, and the policy would fail at age 83. They also needed additional coverage. As we worked through this, trying to find the right policy, we then further determined that we could move the death benefit up to $1.4 million, maintain the same premium that they were paying of $8,500, and again give them the benefit of a lifetime guarantee, a policy that they could theoretically put under the mattress.
Another situation where you could lead to an increased death benefit is if you have an older policy that isn't necessarily failing. It may be doing very well, but it has a lot of cash value, which isn't important to this client. And sometimes in those situations, you can use that to get a much larger death benefit with even a smaller premium in many cases.
And I'm going to digress for just a moment based on what Bob said. I was around when a fellow from Southern California invented the concept of a vanishing premium. And because of my past history, it was with New York Life. It was called premium offset, but companies had all different names for it. And all it was how to utilize dividends differently than we had been using them in the past. In the past, most of our policy illustrations, and this is ancient history, our illustrations would either show dividends accumulating at interest, buying paid-up additions, or reducing the premium. In this case, we were able to develop the short pay. And in the beginning, it was all done on a spreadsheet with a dividend projection. And I think most of you know that for the longest period of time, certainly through the late 70s and into the early 80s, most policies prior to universal life, most policies that had cash value were participating policies, and most insurance companies that issued those policies usually paid a dividend higher than illustrated. It was the culture that we were brought up in, and it was that change when universal life evolved by, I guess it was E.F. Hutton that introduced it in '79, when interest rates were 13–14% on a policy. The major change was, instead of a portfolio that was very balanced and wasn't affected by major change, it was a new money portfolio that was much more subject to change. And that's when we started to see, as the economy changed and yields went down, lowering interest rates on universal life policies, decreased dividend scales on permanent whole life policies. It created a bunch of problems at the time. So what Bob said was, you may have a well-performing policy, but the ratio of cash value to death benefit might be 60% cash value and 40% death benefit. Therefore, on a $1 million policy, the net amount at risk for that client is really only $400,000 because they could take out $600,000 on their own. This was an opportunity back then that we talked about, which was kind of Ben Feldman-ish, which is, let's just change the account that holds your money. Let's move your $600,000 from here over to here and put the insurance company back on the risk and bring the pure amount at risk up to $1 million. So with well-performing policies, there can also be an opportunity to do something for these clients.
I just want to throw in one brief comment. Alan used the word vanishing premiums, and I think we all know that is something we probably shouldn't say to clients because they haven't vanished. They were just, in these cases, being paid with dividends.
Yeah. So moving on to outcome number 3, and this is where we are unbiased. This is theoretically a policy that we look at in a similar fashion. It has the same $8,500 premium. It has still only a 5-year guarantee, but the policy is working well. It's holding on. You look at the performance of the policy to age 100, and it remains in force, and in some cases, maybe it even matures as an endowment at age 100, depending on when the policy was issued. And in this case, if we ran into a policy within the review, we would have commentary that would say this policy shouldn't be replaced for the following reason. There may be, though, still another piece that we would look at it, because if they had 3 underperforming policies it's quite likely by merging all four into one new, the well-performing policies' values could help the shortfall on the three failing policies wind up with the same amount of insurance but in a better position down the line. Option 4, again, where the policy is performing well. And this is where I think a policy review is important. A lot of us think that, well, this is just a sales opportunity. We can get in front of the client, we can use it, we can disturb them, and we can replace the policy. We know that replacements have become a very big issue. They have been for some time. So just a moment to talk about a policy and the opportunity to further develop the relationship with the client. Is a policy performing well, but you then take the opportunity that you're in front of the client and you say to the client, look, when you bought the policy, you had something in mind about what you wanted it to do. What's changed between then and now related to this policy? Let's look at the beneficiary designation. Maybe some beneficiaries have changed. Maybe they've died and there's nothing in it to take their share to their next generation. Ownership. There's the opportunity to say, gee, has your estate grown? Maybe we need to look at somehow getting this out of your taxable estate. If your estate is taxable, there's no sense in giving up 45% of this policy. It's an opportunity from the review to segue in with an existing client to open up talking about what's changed in their life. If you're with a new client, a new prospect that was not your client before, it's also that place that you can move into talking about needs and, again, what's changed in their life. You know, this was to provide income of X amount, which would have been sufficient then. Is that still sufficient? And talk about capital needs analysis.
Sometimes it isn't only because their circumstances have changed that leads to a need to update their beneficiary designations, but we find a lot of policies have not been set up properly in the first place. This is often true in business situations where the policy structure and beneficiary ownership and beneficiary doesn't match the buy-sell agreement. There are often problems with policies where minors are beneficiaries, and this gives you a great opportunity to update those policies even though no other changes are required.
Now, let's talk about replacing a policy. We get into that situation where it's very apparent that the policy should be replaced. We all know that you can use a Section 1035 exchange. I'm hoping that everyone out there understands that if you have an existing policy that has a taxable gain, if you were to surrender it, you would incur ordinary income on that gain today. But if you simply exchange it like you would a piece of real estate, if you exchange that policy for a new policy, the cash doesn't touch the insured's hand or the owner's hands. It goes from carrier to carrier. You avoid taxation on that gain. So you can get a lot more cash value moving over.
It's important to remember, though, that the owner of the new policy must be exactly the same as the owner of the old policy, and the beneficiary are the same as at the time of the exchange. So that if you have older policies that perhaps have different ownership or beneficiary arrangements and you're going to combine them, we need to make those changes before the exchange takes place.
There is some thought that you can move quicker if you surrender a policy. We all know, those of us who have done exchanges know how the time frame has extended, and extended. Sometimes it's 60, 90, 120 days before the original carrier cuts loose the money to the new carrier for lots of reasons. You know, to give their own agent, if you didn't write the policy, an opportunity to go back and talk to the customer. They delay it. So sometimes, you know, you could say, well, gee, if we surrender the policy, it would be better, and there's no taxable gain. Why not surrender it? Then you have complete control. The client gets the money pretty quickly. They pay it into the new policy. Sometimes that's not in their best interest, because if there's no gain, there's probably a loss. Rarely would the cash value be equal to the premiums paid. And it's important, just like again in real estate, by still doing a 1035 exchange, you bring the cost basis over of the original policy, not the cash value. So if the cost basis, the sum of premiums paid, were $200,000 and the cash value was $140,000, if you surrender it and bring over the $140,000, that plus future premiums is your cost basis on that policy. But if you exchange, you bring over a $200,000 cost basis. Now, why would this be important? Let's say this person is in their 50s and somewhere down the line, they say, you know what, we don't need this anymore. And they decide that they want to do a settlement. At that point in time, they have a higher cost basis, which then lowers the tax on the sale of that policy.
Absolutely, but there's also another consideration here why it might be a good idea to do a 1035 exchange, and that has to do with whether the new contract does or does not become a modified endowment contract, which is a rather complicated subject which we need not get into today. But if there would be a problem with a MEC, a modified endowment contract, that's usually avoided with a 1035 exchange rather than a dump-in of a large sum of money in another fashion. And we will talk also about the life settlement, which is another alternative here. And of course, we've talked before about life settlements, and if you don't receive more than the net cash surrender value, including a factor for the tax on the sale, then a life settlement does not become a very profitable transaction. Now, regarding taxation, for many, many years we were kind of flying by the seat of our pants. Nobody really knew what the taxation would be on a life settlement. We thought we knew, and most people agreed, but we didn't really know. And recently there were two revenue rulings, 2009-13 and 14, which dealt with this and confirmed most of what we thought before, namely that any gain up to cash value would be taxed as ordinary income, and any gain beyond that would be taxed as a long-term capital gain. The one thing they did change, and it's an important change, was the calculation of basis, not for the ordinary income portion, but simply for the capital gain portion. And even though the cash value of the contract, which affects the purchase price, already took into account the internal cost of insurance charges, they still say that you need to subtract those from your premiums paid in determining cost basis. It's very new. A lot of people don't agree with it, but it is going to increase the taxable portion of a life settlement, and that needs to be taken into account.
And Bob, when does this go into effect?
Well, the ruling was, it had an interesting provision in it. It said that they will not apply it adversely to any transaction that took place prior to, I believe it was August 26th of this year. So if you have any life settlements out there that you think might go through, let's try to get them through before August 26th, and you'll have more favorable taxation.